Hi everybody. Okay, in an interesting getting off on time. A very good morning to you all, and welcome to this morning's K3 Hub tax update. For those who haven't virtually met me before, my name is Marie Wadeson and I'm a managing director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I am responsible for the K3 Hub, which is a member network for professional advisors developed by us here at Quantuma and other companies within the K3 Capital Group. Since we launched in the spring of 2020, over 2,300 like-minded professionals across the country have joined our network, through which they've accessed a range of CPD and training sessions, not dissimilar to today's event, and referral fees for certain types of work referred into our group. Before we move on to today's main session, and I introduce you to our speakers, just a few pieces of housekeeping. So we are recording today's session and it will be placed onto the K3 Hub website by about the middle of next week. Q&A function is open and I've seen some questions coming in already. So good morning to everybody that's already asked some questions. Do feel free to ask questions as we go. We've got two fairly distinct subjects that we're covering today. So what I'm going to do is I'm going to handle the sessions in two distinct parts. So we've got Jeremy Johnson who's going to speak first. I'll cover questions for him first. Then we'll move on to my colleague Daniel Sladen, and then I'll cover his questions towards the end of this session. So to help me along and to help our speakers, I'd be very grateful if you could give us some context to your questions or a reference point so that we can recall what they relate to and that we can answer accordingly. We've got a runtime today of 1 hour, and I know that we've got a lot of material to get through. So if I don't manage to get through all of your questions today, what I'll do is I'll pass them on to the relevant speaker and they will come back to you directly after today's session. And finally, if you'd like to get in touch with either of today's speakers following today's session, we'll be sharing their contact details towards the end of the session as we're about to wrap up. So, okay, on to our speakers then. So I'm very pleased to be able to be joined by my colleagues, Jeremy Johnson and Daniel Sladen. Daniel's our second speaker today, so I'm going to introduce him in a little while. In the meantime, I'm really pleased to be able to welcome back a regular speaker at the K3 Hub and one of our resident tax dispute experts, Jeremy Johnson. Jeremy is a director at inTAX, a fellow K3 Capital Group company, and they specialise in tax investigations and disputes. Jeremy helps clients to manage and resolve Hmrc inquiries, disclosures or risk reviews, whether fraud, evasion, avoidance or other inquiries. He's a former senior Hmrc inspector for his sins and has substantial insight into approaches and procedures adopted by Hmrc and understands the boundaries within which it should operate. Jeremy's going to talk to us about a number of things today, including an update on the latest Hmrc nudge campaigns and what Hmrc are entitled to ask for. Jeremy, over to you.
Good morning. Good morning, everybody. Thank you, Marie, for the introduction. A couple of quick things before I start. First of all, I've had a cold recently and I'm still got a little bit of a cough, so my apologies if I cough at all throughout this presentation. The second thing is we had a question before this kicked off. There's been a lot of news around proposed changes to IR35. Not something that I'm going to cover, but Daniel will be covering it when he gets to his session a bit later on. So I'm talking about three kind of distinct things today. The first is a quick look at what Hmrc is focusing on, or a few of the things that Hmrc is focusing on at the moment. The second thing I'll cover is a little bit of a run through of Hmrc's information powers, what they can ask for, what the restrictions are, and how they go about that. And then the final thing I'm going to cover is a case study which touches on some of the time limits in VAT. Hopefully that'll be useful for some people, just a reminder. For some people it might be new. So if I could have the first slide, please. So a few areas that Hmrc is looking at the moment. It's looking at lots of things, but a few areas potentially of note that Hmrc is looking at. Firstly, Euro-Pacific Bank, you may well have seen the news, lost its license. Most of the bank accounts are being transferred to another bank at this point in time. Hmrc received details of UK residents who had accounts with Euro-Pacific Bank, sent about 600 letters, is following up on those where people didn't respond. And there are probably going to be further inquiries. One of the things that may have happened with Euro-Pacific Bank is the, and I've lost my screen. If Marie can tell me if I'm still here.
Jeremy, yes, I can see you.
Okay, my screen has just defaulted for some, oh, it's back.
There you go.
So one of the issues that may have happened, there are still lots of offshore formation companies. They don't necessarily give proper tax advice. It's very easy to set up an offshore company. So in the past, it is quite likely that people have set up, UK resident people have set up companies through these offshore formation companies. They'll also open up an offshore bank. If they've got offshore customers, they may well have proceeded on the basis that all of this doesn't have a UK footprint. Whereas if the individual running it is UK resident, doesn't matter where the company or the bank was, very likely to be UK tax residents. And there may be people who don't think they've got a problem, but who do. The other area that HMRC is looking at is the offshore ownership and disposal of UK property because of the changes, or the relatively recent changes in the rules in relation to capital gains. So in 2015, non-residents disposing of UK residential property were within the scope of capital gains. 2019, not just residential property, but any property. Where HMRC is getting its data from, I'm not perfectly sure, but I can guess. It may well be linking up information from foreign banks, which it receives on an annual basis, to see where people have had an increase, potentially if they've got a UK footprint, looking at the land registry. But it's working on making sure that those people, non-UK residents who've disposed of UK property, have declared the gain where that was appropriate. Also, a bit of a change in terms of non-resident companies disposing of UK property. From 2019, corporation tax rather than ATED related capital gains, something that HMRC has been looking at. One thing to note, not directly, it's kind of indirectly tax related, is the register of overseas entities. So now if an entity owns a UK property, then it needs to register with Companies House and disclose who the beneficial owners and kind of key people are within that entity. I think that's part of a drive to transparency in terms of what's happening around the world with potentially money laundering and illicit funds going into property in the UK. The final thing, this isn't new, it's been going on for a long time, but it continues, and HMRC is still running it. We still get people approaching us to help them with this, is the Let Property campaign. People owning properties, frequently not understanding that they're making a profit, not declaring a profit, not declaring the capital gains. Quite often what we see is kind of accidental landlords, where people have moved house, kept a previous house and rented it out, never really planned to be a landlord, but they've ended up with a liability. And the final thing, capital gains on disposals of shares. So HMRC's spending a bit of time looking at whether people are declaring this properly. We do see cases where this has been missed, either accidentally or on purpose, perhaps. If you've got a small business run through a limited company and it's sold to somebody you know, if you arranged for the money to be paid to you personally and then just wind up the company on the basis there's no assets there, there's a capital gain potentially that's been missed. So those are a few of the things that HMRC is looking at. Moving on, we've got the, if I could have the next slide, I was going to run through information notices. What can HMRC ask for? It's something that we spend a bit of time considering, depending on where we are helping a client with an inquiry. The powers, for the most part, are enshrined in Schedule 36 of FA 2008. The usual things that we see are first or third party notices. In other words, a notice either to the taxpayer directly or to an entity that the taxpayer has been dealing with, perhaps the bank. It could be customers, it could be suppliers. That's what we're usually dealing with. There are some other kinds of notices that HMRC can issue, but that's what we most often deal with. the first thing to ask is it reasonable for HMRC to ask for things? We operate on self-assessment. People submit their company tax returns, personal tax returns, on the basis that they've analysed their own position and decided what the tax should be. So, it seems perfectly right that HMRC should be able to ask questions and check that that's okay. In terms of what HMRC can ask for, HMRC can ask, and I won't cover inspection powers, they're within the same piece of legislation, but a separate thing. HMRC can ask somebody to provide information or produce a document. One thing to note is they can't demand that you create a document. So if there is a specific document that HMRC believes should exist, they can't insist that it's made. And the overarching condition in relation to this is the information or the document that HMRC requires or is asking for needs to be reasonably required for the purpose of checking the taxpayer's tax position. So there has to be some relevance to what they're asking for in relation to the tax return that an individual or a company has submitted. So, for example, could HMRC ask me details of where I went on holiday last year? Potentially, that would be completely irrelevant. Where did I go? What did I do? However, if I went on holiday and spent half of that time at a business event, and some of the expense relates to me, some of the expense relates to the business, it might be perfectly legitimate for HMRC to ask details of that holiday, because potentially part of the expense, if I've claimed it, that they'll be looking to make sure that there isn't a duality of purpose, that I'm not claiming for stuff that is in fact my own. So it's got to be reasonably required for the purpose of checking a taxpayer's tax position. The information or particularly documents have got to be in the person's possession or power. So if HMRC is asking me for something, I need to have it or be able to get it. The or power bit is sometimes a tricky thing. So, for example, if HMRC starts asking me to get information from one of my suppliers in relation to the transactions that we've had, if I habitually say, yes, that's fine, and I go to my supplier and I get the information from that supplier, and then I pass it on to HMRC, then HMRC, if later on they ask for something that I didn't want to give them for whatever reason, HMRC would argue, well, habitually you're able to get this from another person. So we argue it is in your power. So if you're not going to provide it to us, we're potentially going to start issuing penalties. So in very complex inquiries, it does beg the question of how much should you ask other parties to transactions for information in order to give to HMRC, compared to saying to HMRC, if you need information from those individuals, then you're going to have to approach them yourself. Otherwise, you potentially put yourself into the position of making other people's stuff within your power. One of the parts of the legislation, there's a number of restrictions in the legislation. Excuse me, there's a number of restrictions in the legislation, and one of the restrictions looks at whether there is an open inquiry, and this is in relation to income tax, capital gains tax, and corporation tax. So if there's no open inquiry into return, HMRC can still use its information powers, but there are a number of conditions that it would have to meet, and one of the conditions that it typically would have to meet absent an inquiry, it must have reason to suspect that there is a loss of tax. Reason to suspect is a relatively low bar. There are a number of tax cases that have considered this. One of the more recent tax cases that considered this year kind of ran through a number of the previous ones. The court determined that reason to suspect is probably somewhere close to sufficient information to raise a discovery, somewhere around that. But the courts have made it really quite clear that reason to suspect is quite different from being interested in. So HMRC would have to show, if it issues an information notice for a period of time where there isn't an open inquiry, that it has enough evidence that it has reason to suspect that something is wrong within that tax return. It's also a little bit intertwined with reasonably required, in as much as there must be an assumption that HMRC must be able to assess for that period. So it links in with time limits and behaviours for discovery assessments. So, for example, if HMRC were to ask for something 30 years ago, or that happened, a document from 30 years ago, HMRC doesn't have the ability in any circumstance to make an assessment in relation to something that happened 30 years ago. So you would argue, it simply can't be reasonably required, even if it had reason to suspect that something went wrong in that year. Other taxes. So the reason to suspect qualification comes in where you've got an individual tax return or a company tax return typically. If HMRC is asking about VAT, if they're asking about pay as you earn, they don't necessarily need reason to suspect, because those types of interactions are not governed by inquiry powers. So if they're asking about VAT, that you don't necessarily have the same kind of qualification of reason to suspect. You can appeal information notices. If HMRC has been to the tribunal and got an information notice tribunal approved, you can't appeal that. If it's issued directly to you, you can certainly appeal that if you wish, if you think it's unreasonable. And also, if HMRC is asking for statutory documents, that information notice can't be appealed. It begs the question as to what exactly are statutory documents, and there isn't a perfectly clear answer to that. But if you were to attempt to appeal an information notice that HMRC said contains statutory documents, it may well be that if it went to tribunal, the tribunal would look at that and say, no, they're asking for statutory documents. These are statutory documents that they're asking for. So, we're not going to hear this. There's no right of appeal. There are some exemptions in relation to information powers, things that HMRC can't ask for. Legally privileged communications, and that has to be from a legal professional. Various auditors' papers, or some auditors' papers, they can't request those. Tax advisors' relevant communications. So if a tax advisor is giving advice to somebody on their tax position, HMRC can't insist on that using an information notice. Old documents over 6 years old, HMRC can't ask for those unless it has internal approval. So sometimes if they are asking for very old documents, it's worth finding out if they've actually followed their own internal procedures. And personal records, which are defined in PACE, which are effectively records about your health or mental or spiritual well-being. So there's a really quick race through information notices and information powers. HMRC can ask for things, but there is a framework that provides some protection restriction in terms of what they can ask for. It's not completely unfettered. I'll move on now to the final part of what I'm going to talk about today. If I can have the next slide, thank you. This is a recent case study, and I thought it was interesting, and we found it interesting. It was a challenging case, just in relation to time limits on VAT. There's the general time limits on VAT of 4 and 20 years, depending on behaviour. Up to 20 years, HMRC can assess if somebody's behaviour is considered deliberate. But the 4 and 20 year restriction, there's also a 2 year and a 12 months, a 12-month rule. And what this 12-month rule says, from the point that HMRC has sufficient evidence of facts, it has 12 months within which to raise an assessment. And this applies for any assessment that's more than 2 years old. So if I was a VAT officer, if today I was looking to raise an assessment for a quarter, let's say in 2019, so it's more than 2 years old, If today I have sufficient evidence of facts to raise that assessment, I have 12 months to do that. And if I don't do it beyond those 12 months, or if I don't do it within those 12 months, I can't do it. The assessment is effectively illegitimate. HMRC doesn't always keep a track of this properly, and the way that it looks at the legislation and guidance, it doesn't always do the right thing. So just to run through this case briefly in terms of what the key dates were and what was happening. This was a restaurant running partnership. HMRC had third-party bank information from a merchant acquirer, and also from data from one of the delivery companies. In August 18, they visit the premises and they get till data from the restaurant. In December 18, HMRC writes to the restaurant and say, we believe when we add up what was in the till, what we've got from this other merchant acquirer, what we've got from the delivery company, we believe that the sales are actually lower than the VAT returns. So they write that. Various correspondence happens and information is passed between the parties. On the 22nd of August 19, HMRC scheduled a meeting. They went to the meeting. The individuals from the restaurant couldn't attend, so the meeting didn't happen. On the 2nd of October, that meeting did happen, and there was a discussion. On the 25th of October, there was another meeting to discuss the data with the accountant between HMRC. And then on the 30th of September 2020, the VAT assessments were raised. Most of the VAT assessments raised at that point, apart from one quarter, were more than 2 years old. So whether or not we agreed with the quantum of the assessments that HMRC had issued, and we didn't, in fact, but whether or not we agreed with the quantum of the assessments, the key point was, at what point in this process did HMRC have sufficient evidence of facts? We believe that they had sufficient evidence of facts before 30th of September 2019, effectively, when we looked at what had happened before. We issued a subject access request to HMRC to get all of their internal information. Not everything that we believe that they would have had was provided. HMRC had produced data on the 25th of October. We asked them for all the details of when that data, and that data fed into the VAT assessment at the end. We asked them when they produced that in the first place, because those were the numbers on which they based the assessment. So if they produced that data before the 30th of September 19, then they were clearly out of time. They wouldn't tell us when that was originally created. We spent quite a lot of time arguing that they would have produced that data for the meeting on the 22nd of August. They probably, in fact, knew on the 21st of December 2018 everything that they needed to know to raise the assessments, so they're well out of time. HMRC continually argued. At first, they argued that it was the 2nd of October meeting that gave them the evidence, and then they argued it was the 25th of October that gave them sufficient evidence. We eventually had to appeal the assessments, notify them to the tribunal, because we asked for a review. The review decided that HMRC were in time, because they got the information they got on the 25th of October was what they needed to raise the assessment in October 19. We continued to argue and eventually went to an alternative dispute resolution with HMRC to discuss this point. And one of the key, HMRC were never really telling us when they created the data that they used to issue the assessments. But what was clear when we got the meeting notes, HMRC's own meeting notes from the 2nd of October 19 and the 25th of October 19, in fact, when you looked at the meeting notes, although questions were asked, nothing new was provided to HMRC in those two meetings. HMRC did not get from the restaurant anything new, any new evidence in those two meetings which would have impacted on the assessment that they did eventually raise. And in fact, when we went through the chronology in a slightly longer form than I'm doing now with HMRC and took them through what had happened, what the assessments were based on, and clearly the times when they must have known that information, relatively quickly, HMRC agreed that in fact they were out of time, and all apart from 1/4 of VAT assessments were out of time. So in relation, and this is something that we see relatively frequently on VAT assessments, is HMRC believing that every interaction with a client gives them a further 12 months within which to raise an assessment. So if they have a meeting, a discussion, send a letter, or ask a question, they believe that that is something that creates a further 12 months for them to work on, and that isn't necessarily the case. So always worth looking. When did HMRC have the information? When did they raise the assessment? When did they have evidence of facts? So that's the end of my session. Hopefully that's useful. A few areas that HMRC is looking at: the information powers, and finally just look out for timing on VAT assessments.
Thank you very much, Jeremy. That was very detailed and very informative. We have, as you probably will expect, had some questions in. So if you sit back, I shall put you through your paces. So firstly, there is a question that's coming from Mark. Now, going back to the nudge campaigns that you talked about at the outset. So under a let property campaign check, how far can HMRC ask for details of previously undeclared rental income?
It depends whether you're asking or disclosing. It comes down to behaviours. So if HMRC could demonstrate, or if your client knew and can't argue that that they knew they should have been declaring their let property income and there was a profit, HMRC can go back for 20 years. If somebody was careless, that restricts the amount of time that HMRC can go back to 6 years. It may be that HMRC asks for stuff beyond that, and you would have to have an argument about, well, it's irrelevant because whatever happened, our client, my client, maybe they didn't take reasonable care, but they were careless at worst. So we've only got 6 years. So it's going to depend on behaviour. If somebody took advice and advice from a reasonably, a properly qualified person, if that advice was incorrect, that person would still potentially have taken reasonable care, assuming the advisor had taken reasonable care. That would restrict it to 4 years. So you've got the 4, 6 and 12 years. 4, 6 and 20 year rules in general.
Very good, thank you. A question from Don then. So does the 12-month rule cover other taxes other than VAT?
No, it doesn't. It's specific to VAT. There's been argument on direct taxes about the staleness of discovery. So if HMRC discovers something and then raises an income tax assessment 3 years later, is that too long? Has it gone stale? There were some tax cases that said yes, and then finally we've had a senior court's decision which says no, staleness is not a concept that exists in direct taxes. So no, that one doesn't.
Okay, thank you. Another question here. So when making a disclosure, is it possible to claim refunds for some years and ask that to be set off against other years where there is a liability?
Often, potentially, yes. So often if you're going back and recreating a client's position, a lot of people we see in the very first years, there's a loss. Quite often if somebody has a new property, a lot of work goes into it. So you've got a loss in the first 3 years and you would want to carry that through. Potentially there's an interaction with the time limits for claiming losses, but you would hope that HMRC would take a reasonable view that if you gave an analysis of 7 years, the first 2 years were losses, they wipe out the third year's profit, and actually it's only the fourth year onwards that we've got a profit that we need to declare.
Lovely, thank you. Hope that answers the question. Another question here. So this is going back to, I think, the nudge campaigns again. So somebody's asked here, offshore offshore companies register details.
Offshore companies owning, I'm not sure exactly how to answer that question or what the question is, but offshore companies or entities owning UK properties now have to register with Companies House and who the beneficial owners of the company is. And just going back to my notes, that went live in August of this year, and it relates, so in England and Wales, any property owned since January 99. And in Scotland, property owned, you need to do this, you've got property owned since December 14.
Very good. Hopefully that answers that question. If it doesn't, then if you drop us a note on the Q&A or on the chat, we can come back to that one later. Just two more for you now, Jeremy. An update on, oh, hang on, no, that's wrong. I'm reading the wrong thing here. So going back to, I think it was your second slot where you were talking about what HMRC are legitimately entitled to ask for. So question reads, can HMRC ask for the personal bank statements of a company director?
So the starting position would be probably not. However, if there are interactions, if there are financial interactions between the company and the director, beyond just the company paying them a wage, let's say, like, for example, if a company director habitually paid most of the company expenses personally and then reclaims them from the company, and there's a lot of interaction between the parties, it might be legitimate for HMRC to ask the question, to see the company director's account so they can see that expenditure being made. Or if HMRC had evidence that an individual was receiving payments directly rather than those payments going into the company and being booked in the company accounts. In that circumstance, maybe.
Okay, thank you. And finally, you touched upon HMRC's alternative dispute resolution process in your in the case study slots. The question reads, is HMRC's alternative dispute resolution process generally useful?
My experience and our experience as a firm is much more often than not, it is useful. We frequently got really good answers, and quite often, if you've got a case where the correspondence has really just got stagnated and clearly each person, each party, each side of this argument is just not seeing the other's point, having the focus of an ADR session where you're discussing it, you've got a time limit on it, you've got somebody mediating, you can sometimes break through that deadlock that you might have reached in correspondence where perhaps you're just not understanding, HMRC believes it's saying one thing, but you're just not getting that from the correspondence, and vice versa. Actually having that focused discussion can cut through a lot. And you can also get to the point where if you've got lots of issues in a dispute, you might be able to knock off and agree half of them, so at least you've got them off the table, and can concentrate on the things that you don't agree on.
Very good. Thank you very much, Jeremy. That brings your questions to an end. I thank you for your time this morning. So I'm going to move on now to our next speaker. So I'm very pleased to be able to introduce my colleague Daniel Sladen to you. Daniel is a managing director at K3 Tax Advisory, which specialises in corporate and business tax. He advises on financial structuring, international tax and complex transactions, and his background is in capital markets and finance. Amongst others, his clients include business owners, private equity managers, and shareholders in small to medium-sized corporate groups and family companies. Daniel's put together a summary of our response to the emergency mini budget, which is seems to be grabbing the headlines every day. And he's going to look at the imminent tax changes and the year ahead and discussing what the tax planning implications might be. I think we've got a poll question coming up fairly shortly as Daniel gets going, so please do look out for that. And obviously, goes without saying, we'd love to hear your views. So, Daniel, over to you.
Okay, thanks, Marie. And that maybe suggests a degree of definiteness to the content that I may not be able to live up to, but I'll do my best. So just over 3 weeks ago, I suggested a good seminar topic for today would be to talk about tax announcements in the mini budget. I think it's fair to say none of us really expected what was going to happen next. So just to put this in context, as far as I know, everything I'm saying was correct as of about 10 p.m. last night. And as far as I know, the Chancellor is also still the Chancellor this morning, and there have been no further changes, but it's clearly a moving situation. So before I get into the Chancellor's announcements, it's a good idea to take a step back from the general chaos and news cycle of the last 21 days and remember what we were thinking about ahead of the mini budget. Actually, we had something of a poll within our tax team, and the general consensus then was that the national insurance increase would be cancelled, which had been widely trailed. There would maybe be some offsetting measures on thresholds to cover some of the cost, and perhaps the corporation tax rise would be reduced a bit or delayed. But in general, the feeling was that it was a question of looking at measures which might give a little bit back to help with the energy bills in addition to the energy package, but perhaps some other measures to help ways of paying for those costs. One brave individual in our team did actually suggest that the 45% income tax rate would be removed as part of the statement. It's probably fair to say the main reaction was to laugh at that suggestion. Of course, we were right in that reaction in the end, but it was quite an interesting week or so until we were right. Of course, what actually happened was that the Chancellor followed up a hugely expensive intervention to help with rising energy prices with a number of other hugely expensive tax cuts. There was nothing on the fiscal side announced in the statement to offset the cost of the tax cuts. And that was initially at least deferred to a further statement to come in late November based on OBR forecasts and focusing on spending and supply side reforms. So using the Treasury's own figures, I'm going to go through some of the key measures and the likely costs. I've used the annual cost that each measure has by 2026 because there's a lot of volatility in earlier years because of the process of introducing changes or things being forestalled or people accelerating tax, etc., etc. For those who are interested, they're on page 26 of what was published by the government as the Growth Plan 2022. It's a lot of small numbers, so I won't put it on screen, but it's on the government website for anyone who wants to have a look at it. So first of all, as mentioned, there was the cut to national insurance, both for employers and employees, and the removal of the forthcoming health and social care levy. That was due to be introduced next year and would kind of formalise the 1.25% rise that had temporarily been put onto national insurance. This was widely expected to happen. It came at a cost of £15 billion per year. Next, the most expensive surprise was the complete cancellation of the plan to increase corporation tax to 25% for larger companies from April 2023. So this wasn't a deferral of the rise or a change in the rate it was going to be increased to, just a complete cancellation. And the cost of this was put at £19 billion a year. Now, compared to those two items, the other changes really are pretty minor in scale, but as the saying goes, $1 billion here, 2 billion there, and fairly soon you'll be talking real money. So let's just pick out a few examples which are particularly relevant from a tax planning point of view. So first up, the now infamous removal of the additional rate of income tax being 45p on most income and 38 or 39p, depending on how you see the NI rise on dividends. That had a cost of approximately £2 billion. Next, there was the acceleration of the basic rate income tax cut, which is being cut from 20% to 19%. That costs an extra £5 billion next year. Beyond that, it's seen as neutral because cutting it in 2024 was already in the plan that Rishi Sunak put together as Chancellor. All the same, seeing that £5 billion, it's worth being aware quite how much revenue a single penny on basic rate income tax raises. Then there were some increases to the SLT thresholds in order to stimulate the housing market, perhaps working against what's happened to interest rates since, and that came into a cost of roughly £1.5 billion. Finally, there are two more items I think that are worth mentioning. There was the welcome extension of the annual investment allowance to £1 million a year on a permanent basis. Previously, it's only been put in place on a temporary basis, which perhaps makes it harder to plan. That has a cost of about 1.3 billion a year, but is perhaps the one policy that is seen by everyone as a straightforward way of promoting growth. And then there was the surprise decision on the other side to abolish the off-payroll working reforms in relation to IR35. I don't think anybody really was expecting this. We don't yet have full details of exactly how the measures will work and what will be left in place and what will be changed. But the basic impact is to completely remove the move towards enforcing correct taxation of contractors via the end engager in the process. So typically the larger companies or public sector organisations that would be engaging contractors. Effectively, this is an enforcement change rather than a tax change, because the tests for employment status and so forth are not being changed by it. Despite this, despite not being a change to the actual tax due, the forecast is that it will cost £2 billion a year, which suggests that there will be rather less successful enforcement in future. And of course, as people who've been involved in this area will know, the whole thrust of the measures over the last 5 or so years has been to try and make it possible for Hmrc to collect tax from those who don't stay on the right side of the rules by being able to look at the engagers, not just at the individuals and their companies that are rather harder to recover tax from. So thinking about all of those, the reaction over the last 3 weeks may not have been exactly what the Chancellor hoped for. You all have seen the news about bond markets, mortgage rates and so forth. Now, I'm not an economist. I'm certainly not going to try and untangle every bit of cause and effect between the different tax changes and other factors like wider global interest rates, FX rates and so on. But the key takeaway of where we now have ended up from bodies like the Institute for Fiscal Studies is that the government will need to change course and plug a gap in the annual budget of somewhere between 45 billion and 60 billion pounds a year. And again, think of those numbers in the context of what I've already mentioned. 60 billion a year could be seen as 12p on the basic rate of income tax. That's a difficult amount of tax to find. So there are a lot of detailed changes that might be worth £1 billion or two, and for all of those who grew up with Gordon Brown's budgets and subsequent changes under Osborne, there were lots of little measures and stealth taxes that made those kinds of changes. But raising the amount of money needed will need some serious thinking about the main taxes. So I've mentioned income tax, particularly at the basic rate, but corporation tax and VAT are really the taxes where large amounts of revenue could be raised. So the question really affecting all of us now as professionals working in tax is, how will they fill that gap? What does that mean for planning right now? So as a starting point, I thought it would be interesting to try and answer this question by seeing what people on this webinar think are the most likely tax changes. So we have a poll addressing this, which has certainly appeared on my screen, hopefully on everyone else's as well. You should be able to select as many of these as you want, and I've tried to identify the key choices that I think could raise decent amounts of revenue. So please do drop your votes in now, and it'll be interesting to see where people think the Chancellor might be going with raising revenues. And just to talk through what we have there, we have a reinstatement of some or all of the planned increase in corporation tax. Clearly there's some briefing going on that. Once again, deferring or removing the 1p income tax cut, extending the income tax threshold freeze, increasing VAT, or looking more to capital taxes, particularly CGT and inheritance tax. So I'll just give that a minute for some votes to come in. I'm not seeing any appearing live, which I hope is how it's meant to work, but we'll give that a moment.
Daniel, I think we wait until everybody's voted and then you will share the results with you.
Okay, that's good to see. I was expecting some growing bars kind of biasing everyone's views. So let's just give that another 20 seconds or so, and then we'll see where we get to. Right. Okay, well, thank you for your votes, which I now have in front of me. So interesting takeaways, really. There's a very strong view that the corporation tax reversal is going to be re-reversed, if that's the correct phrase. And obviously, we've all seen the coverage overnight. I think what was interesting is that after rumours surfaced yesterday lunchtime that the corporation tax rise would be reinstated, the performance of sterling and UK government bonds increased dramatically on the market, seemingly because the markets believed that cut would be reversed and didn't believe the government's denials that it would not be. So I think it seems that we're now in a position where there will be considerable market turmoil if that is not reversed. It'll be interesting to see at what level, whether it's a full 25% or whether there's some kind of compromise level. In terms of other results from the votes, we've not got a majority thinking that any of these other changes will come in, but roughly 30% or to 40% looking at getting rid of the 1p income tax cut again, extending the income tax threshold freeze further. That, of course, will only make a difference to the public finances in about 5 years' time. And also about 30% looking at CGT or inheritance tax. Very few people on VAT, which kind of makes sense because increasing VAT has the scope to increase inflation and of course is very regressive. It takes money off exactly the poorest people who will be most impacted by energy price increases. Now, we certainly don't have any more insight than anyone else who's attending this webinar, and perhaps less depending on who people know. The only thing I would say is that politically it's easier to maybe raise some revenue through things that were not already dealt with in the mini budget because it's a little bit less of a U-turn. So I wouldn't rule out looking at VAT. I wouldn't even rule out looking at CGT and inheritance tax, although that is very contrary to the general attitude of incentivizing entrepreneurial behavior and growth. But overall, I think it's clear that the markets, Parliament, the electorate are not going to support the current course of action and that there's very little appetite for spending cuts. There's a lot of concern that further cuts will also reduce economic growth and make the position worse. So our central view is that the gap will have to be filled with tax rises of some kind. The thing then, though, is it's difficult for us to be sure how or when there'll be a change of direction, and there are really three quite distinct possibilities. Now, one of them is that the current Prime Minister and Chancellor accept that they need to change course and reverse most of the recent decisions to get back some kind of balance, maybe with a few extra changes as we've just discussed. The second is that the Conservative Party installs a new leader who takes a different direction. That's been pretty widely trailed in, I think, the Times, particularly overnight. And the third is that nothing much changes until there's a general election, which could be sooner or later, could be as long as 2 years away still. If nothing has changed, that would result in a new and probably Labour or Labour-led government. So bringing this back to tax planning, we really need to think about which kind of tax changes that we're all concerned with might happen and what we should be doing now to manage the risks that that brings. We can't know what's going to happen, so it's more a question of just protecting ourselves against reasonably probable things that would have a bad effect. There's so many unknowns here that I've focused on possibilities that could make a really material difference to planning. So first of all, let's say the current government does stay in place. I think it's reasonable to assume they will make as few changes as possible, but this is likely to mean that we've still got an unstable tax environment because changes are gradually forced over the coming months. I think in that situation, all we can really say is predictions are very difficult. We can't plan on the basis that we have any real understanding of the longer term tax environment. If we think instead about the Conservative Party anointing a new leader, the focus will probably be more on stability and trying to steer a predictable course to the election. Of course, it will also involve trying to win that election, which is no more than 2 years away. And I guess that's likely to mean looking for more popular tax policies. And broadly, that is trying not to increase tax too much at the bottom of the income scale, looking to raise tax from the wealthier, from larger businesses, and so on. And the final scenario, an election leading to a Labour government, well, that's probably fairly similar to the second scenario too. We'd expect maybe to see a bit more tax targeted at the higher end, and again, a bit less on lower incomes, probably a greater skew towards the wealthy. Labour might be more comfortable looking at ways to tax wealth, like increases in CGT and IHT, than the Conservatives have traditionally chosen to do. Although, as we've seen, the main revenues aren't raised through the capital taxes, which of course are the main ones we really think about with a lot of planning, they do have an important role in political signalling, and it's much easier to raise taxes that affect everybody if the wealthier seem to be paying their fair share through changes to capital taxes. So bringing all of that together, it actually leads to really quite similar planning advice, whatever happens. And I'm afraid it is actually what we've been saying for the last few years, which is that tax rates are historically low. We don't think it can be lasting forever. And there's a risk of sudden increases in taxes on wealth and on capital. Pretty much in all cases, that's probably become more imminent and more likely as a result of the events of the last month or so, but it was probably something we thought was coming down the track anyway. That could include things like increasing the rate of CGT, Again, it doesn't raise that much around the margins, but if, as has been discussed, CGT was harmonised with income tax rates, the net yield on a sort of stable basis once it's been introduced could be something like £7 billion a year. That's quite a worthwhile amount of money in the context of the numbers we're talking about. Other things like reducing relief such as BADR, which of course over the last few years the Conservative government has already reduced from 10 million to 5 to 1, could be a way of yielding a bit more revenue. It's not a massive number for that one. Many people think that some of the inheritance tax reliefs are very generous as well, and there's been talk of reforming or limiting agricultural property relief and business property relief for years. And I guess with all of these things, the planning point is that there could be changes that are quite targeted, but changes do have a habit of bringing in more transactions than intended, creating unintended consequences, creating uncertainty. So even if our planned transactions aren't caught, they might still be riskier or have a less certain tax treatment. So the advice in this climate has to be it's better to act now and have certainty about tax treatment. The changes are not likely to be favourable. The reaction to the mini budget shows how hard it's going to be to take any steps towards tax cutting in the next few years. So we do have to predict that across the board changes are upwards and not downwards. So if there are business sales on the radar which can be pushed forward, now is a good time to get on with it. If there's succession planning which relies on inheritance tax reliefs or lower rates of capital gains tax or capital gains tax reliefs, it's definitely a good idea not to delay further with anything like that that's in your client's control and can be proceeded with rather than postponed till a better time. Really, any restructuring that might lock in capital gains tax at the current rates in particular is worth looking at. And of course, we'd be keen to discuss how we can help you with any of that planning. Now, I think it's been about 20 minutes since I've checked Twitter, so it's possible that what I've said is already out of date. So I'll leave it there and answer any questions that have come in. Marie, have I missed any news while I've been talking?
I don't think so, no. I've also been watching Twitter. Thank you very much for that, Daniel. It was extremely considered, and I was watching your emails at 10 o'clock last night. So thank you very much for that. We have had some questions, so I'm just going to make a start on those. So the first question reads, will CGT rates be aligned with income tax rates?
I mean, obviously I mentioned that as a possibility, and there's an interesting paper that Dan Needle, a tax policy specialist, ex-Clifford Chance, put out this morning arguing for the raising £7 to £8 billion on that. So it is a good revenue raiser. My feeling is it's not likely. There is some evidence that CGT rates rather below 40% actually raise more tax. That was behind the cut back around the 2010 election. Equally, the rates now are historically low. They probably could be increased quite substantially and raise some money. So I would say it's on the way back closer to income tax, but won't get all the way there.
Watch this space then. Very good. Thank you. Next, the question reads, do you think there's any likelihood of a wealth tax being introduced?
Yeah, that's an interesting one. There was a report, which I'm sure many people on here will have seen last year, which was considering how a wealth tax could be designed. At the time, the thinking was a one-off tax on wealth to pay for COVID. I think it's fair to say that worldwide there is a move more towards taxing wealth rather than income and gains because of the recognition of how wealth is held and used these days. It's very difficult to design. It's hugely complex to implement, involving valuations and so on. And the biggest issue, I think, is it only really works if you introduce it quickly without giving people too much warning, because it tends to be quite easy for wealth to end up somewhere else quite fast. So politically, I think there'll be more clamour for it. I'm not sure it's something that's time has come yet because it's just so hard to do.
Very good. Thank you very much. And the last question that I've had in for you, you haven't said anything about windfall taxes. Do you think there will be more use of those in the future?
Yeah, no, I thought about windfall tax and whether to discuss them. I guess the nature of windfall taxes, when they're done properly, is that they are what they say on the tin. They're designed to yield tax from unexpected profits that businesses make from typically global or geopolitical events. So obviously in this case, energy firms from the events in Ukraine. Now, it seems entirely politically sensible that if the government has to spend more money in response to an event and businesses have made unlooked for profits from those events, that those would be picked up under windfall taxes. As we all know, Liz Truss was very against the idea whilst campaigning for leader. Despite that, some element of windfall tax has been introduced. There's more being talked about, although slightly dressed up as price capping. So I think it is bound to form part of the mix because actually even those paying it mostly seem to think it's fair enough. So I think it's in there, but it seems at the moment that the government doesn't really want to make much noise about it. So if I had to think where it fits into the policy mix, I don't think it will be enthusiastically embraced, but in practice, it's probably a way that filling some of the fiscal holes can be achieved.
Very good, thank you. Right, well, I think that's all the questions that we've had, and I can't see any more. So I think the contact details for Daniel and Jeremy will be shared on the screen anytime now. Thank you, team in the background. Our next K3 Hub event is actually all about preparing for higher taxes. This is a structured CPD session, which will be held from 9 o'clock on Friday, the 4th of November. There'll be more details to follow on that, so watch your inboxes. And I'm afraid we're about out of time, so I'm pleased to be able to get you off to address the rest of your days. Thank you all for joining us, and I hope you all have a great weekend.